Most founders think tax planning starts after the company is set up. It doesn't. It starts when you choose your license type, your jurisdiction, and your structure. Sole establishment or company, mainland or free zone, a single entity, an entity with branches, or a group with subsidiaries. These decisions can affect your corporate tax position, your tax cost, your available reliefs, and even how attractive your business looks to investors or future buyers. So if you are building a UAE business with a clear growth plan, investment strategy, or future exit in mind, structure is not just paperwork, it is part of your tax strategy. Most businesses choose their UAE structure based on speed, license cost, or what seems simple at the time. That may work at the setup stage. But as the business grows, the structure starts to affect much more than the license. It can affect how profits are taxed, whether reliefs or exemptions are available, and how clearly the business can report, raise funding, distribute profits, bring in investors, or prepare for a future exit. What founders often miss: the structure does not stay in the past, it follows the business. As the business adds new activities, customers, related party transactions, investors, or entities, the original structure continues to shape the tax position, financial reporting, and flexibility. So the real question is not only which license is fastest or cheapest, it's which structure supports our tax position, reporting, and growth plan. So let's map that out, decision by decision. Let's start with the first structural decision: legal form. Sole establishment, freelance permit, LLC, private limited company, partnership or unincorporated arrangement. For tax purposes, legal form affects much more than the name on the license. It can determine who is taxed, when obligations begin, what deductions are available, and which reliefs or special regimes may apply. A sole establishment will be treated together with the individual owner, where the 1 million dirham natural person threshold becomes important. An LLC or company is generally taxable in its own right, with corporate tax obligations assessed from incorporation. An unincorporated partnership passes the tax position through to the partners. So legal form affects tax liability, registration timing, deductions, reliefs, and tax planning. Once the legal form is clear, the next question is jurisdictional, mainland or free zone. And this is where one of the biggest misconceptions in UAE tax planning appears. A mainland company sits under the standard corporate tax structure, 0% on taxable income up to 375,000 dirhams, and 9% above that. A free zone company may qualify for a special tax regime and benefit from 0% corporate tax on qualifying income. But here is what many founders get wrong. A free zone license does not automatically mean 0% tax. The company must continue to meet the relevant conditions, including qualifying income, adequate substance transfer pricing, and other requirements. If the business has mainland customers, mixed income, or activities across different jurisdictions, the position needs to be analysed carefully. The question is not only where the license sits, it is what the business actually does and where it does it. That leads naturally to the next decision, especially for businesses expanding into the UAE or operating through more than one entity. When a business expands, a UAE company entering a new market, or a foreign group coming into the UAE, the branch versus subsidiary question comes up. A branch is not a separate legal entity, it is an extension of the parent. For a free zone company with mainland branch activities, any income attributable to the branch may be taxed at the standard 9% rate, even where other qualifying free zone income remains eligible for 0% treatment. For a foreign company, operating through a UAE branch may create a UAE permanent establishment, with UAE corporate tax applying to income attributable to that UAE presence. A subsidiary is different. It is a separate UAE legal entity with its own registration, tax return, governance, accounting records, and reporting perimeter. What founders often miss, the branch versus subsidiary decision, is not only about setup cost or speed. It can affect where tax exposure sits, how clean the reporting boundary is, and how easily the group can manage risk later. And as groups get bigger, that boundary becomes even more important. As the business grows, structure becomes even more consequential. A group of companies can create tax planning opportunities. For example, eligible group companies may be able to transfer tax losses between members, helping reduce taxable income within the group. Certain transfers of assets or liabilities may also benefit from qualifying group relief, allowing the transfer to take place on a tax-neutral basis. And companies registered as a corporate tax group may be treated as a single taxable person. This means taxable income and tax losses are effectively combined within one group position, instead of being assessed separately. But none of this is automatic. The free zone tax regime, ownership thresholds, loss positions, tax grouping eligibility, and intercompany flows all need to be assessed before the structure is created, not after. The wrong structure can leave real value harder to move, distribute, or realize efficiently. Before we close, one more point is critical. Tax planning is allowed, but it must be defensible. Tax planning is legitimate. Good structure is legitimate, but structure must reflect commercial reality. The UAE corporate tax law includes a general anti-abuse rule. If the main purpose of a structure is to obtain a tax advantage that does not match the intent of the law, the FTA can challenge the arrangement and adjust the tax outcome. A good structure reflects where people work, where decisions are made, where risks are managed, and where value is created. And just as importantly, it needs to be evidenced. Documentation matters. It is what helps turn a legitimate structure into a defensible one. The substance is the structure. The paper trail proves it. So before you incorporate, restructure, or add another entity, ask these 6 questions. First, who owns the business? An individual, UAE company, or foreign parent? Second, where will it operate? Mainland, free zone, or both? Third, who are the customers? And are any of them related parties? Fourth, what income will the entity actually earn? Fifth, what tax advantages or special treatments could apply? Sixth, what tax, accounting, and compliance obligations need to be planned and managed. At Audiix, we help UAE businesses and foreign-owned entities connect the dots between structure, accounting, VAT, corporate tax, transfer pricing, and financial reporting. So the business is clean, compliant, and ready to grow. Review the tax position before you register a license, not after. Visit Audiix.com or click the link in the description.